In the energy markets today, crude oil had an over 2.5% drop, biggest one-day drop since about September 30th. We now, if you look at the last 2 days, have a 4.1% drop over the last 2 days in the price of crude oil. The spread between Brent and WTI has expanded as well. That's actually widened out about 3.5% today. And that September 30th drop, if you remember, was after the attacks on Saudi Aramco, the sell-off that came after that sort of outsized move that was caused by a geopolitical spike. So put that in perspective, today is a pretty big one-day drop, along with a couple of days we've had. Trade pessimism is one of the reasons for the drop, although it seems to be, it's kind of a mixed bag in terms of the trade pessimism. The U.S. seems optimistic. There's now talk of going back to the abandoned May 15th deal in order to get the tariff reductions that China wants. According to unnamed Chinese officials, that's who reports are quoting, China isn't necessarily ready to do that, and that's what the U.S. is asking for. This all ties to the Phase 1 trade deal that was supposedly completely agreed upon if you go back to the president's speech, but the pessimism is coming from unnamed officials on the Chinese side, not really broad-based. And when you look overall, this is still probably a supply issue, as other reports are stating that Russia is unlikely to agree to excess cuts outside of what they already haven't reached. The last report was that Russia was already producing more than the prior cut agreement, and they're not ready to agree to more cuts. And then you look at the EIA coming out tomorrow, got API coming out this afternoon, but the EIA is much more important. Estimates are for builds in both gasoline and crude oil. Gasoline is supposed to get about a 750,000 barrel build, according to analysts surveyed by S&P Global Platts, as well as a 1.6 million barrel build in crude oil inventories. And that's on top of the continually weak refinery utilization figures, which at this point really should be creeping back into that 90th percentile. You have to go back to 2011 to find a set of data that hasn't quite crept up to 90% yet after the normal drop in refinery turnaround, which happens this time of year. Usually you get to the end of November, beginning of December, and that refinery utilization has started to creep up to 90%. Why does that matter? Because that shows demand directly on the ground. So based off of that, crude oil weak across the board.